Welcome to the show. I'm Mitch Goldberg, your host. You're watching Be the Boss of Your Money. This is the show about the stock market, investing, letting you know what's really going on in the news of the financial world and personal finance so that you can make the best potential decisions, financial decisions for yourself, for your family, for your future. Today, we're going to talk about the stock market because, hey, we should talk about the stock market on a day when the S&P 500 and NASDAQ surged to new all-time highs. That's right, folks. We are at the highest level that we have ever been in for the markets, and enjoy it. And you know something? We've been talking about this about a month and a half, 2 months ago. Stock slid. We were right here on the show saying, don't worry about it. This is not the end of the market, of this bull market we've been in since last October. And I know a lot of people tried it out in the news. A lot of people will say, oh, well, this is why it's down, because of the high interest rates, the strife in the Middle East. And well, I can't even remember all the reasons why. But just understand this. When the stock market goes down a lot, people with a very negative point of view that backs up the thought process of why the market should be down are going to be the people speaking the most in the news, in the media, financial media. If I came out and said, don't worry about it, just invest for the long term and ignore it, the news wouldn't have me on because it's not exciting enough. Sit tight, follow your strategy, follow your plan. It's pretty boring, but I've often said the road to financial success, personal finance success, is a snooze fest. So that is what I continue to think. So the fact that the markets are at a new all-time high, it doesn't surprise me, but for sure, it doesn't change anything at all that I'm doing for clients. As clients get closer to needing to live off of their investments, either because they retired, they sold their business, for whatever reason, they no longer have an income coming in and they have to convert their lifetime of investments into the rest of their life income. As we get closer to that stage, we start scaling out of the stock market and going more into stable assets, more and more in proportion to their needs, well in advance. It's not so much that the stock market goes up or down, which is just so silly to say because we know that, but it's the timing. It's that we can't control when the market goes down. So when we retire, when we flip that switch from turning your passive investments into active income sometime in your life, as we get closer to that, we don't want to do that heading into a severe down market or during a severe down market, which is why we automatically become more conservative as investors as we age. Makes sense, right? And that has nothing to do with the stock market. That has nothing to do with whether or not the market's going to go up or go down. We don't know that in advance. So that's why we practice prudent investing and patient here at Client First Strategy. We're financial advisors. And if you do want some help with this sort of thing, you can certainly reach out to us. Financial advisors are waiting for your call to help you out. Okay. Let's just roll. Let's put the banner in. Let's roll a quick introduction. I say introduction 5 minutes into the show, only not even 4 minutes into the show. That's pretty good today. So I'll pull this up. We're going to talk about the market. We'll let the market. We'll do a quick update in the silly meme stocks, interest rates. What happened today? Why did the market hit new highs? And why is everybody so bullish now when they were so negative a few weeks ago? That is the real story and why I think we could continue to focus on the factors that are leading to the bullishness. Here we go. All right, good to have you back. I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money, about taking control of your money, making you better with your money, helping you live a better life, right? Okay, that's a good tagline. Client First Strategy, helping you build a better life. Every time I think of a good tagline that I like, I think of another one the next day. So like if I had a T-shirt for every tagline I ever came up with, I would never have to buy a new T-shirt again. All right, so the S&P, just I have to get this out of the way. You cannot invest directly into an index, but you could invest into a security that tracks or mimics an index. The broad market, the S&P gained a little over 1% today, breaking 5,300 for the first time ever, closing at 5,308. Tech-heavy NASDAQ up 1.4%, Dow climbing 0.88%. We'll take a look at the numbers in a moment, but just suffice it to say that the Dow closed at 39,908. So that means exactly, not points, it's just 0.00. So we are exactly 92 points. Okay. We are so close to hitting 40,000 for the first time. I remember the first time somebody ever said we could hit 40,000 in the Dow back in the 90s. And it was like, well, I don't know. That's kind of a stretch. 40,000. Now I'm here to tell you we could hit 80,000 in the next 10 years. It could happen. Absolutely. Okay. Growing at 7%, 7.2%. We could do it in 10 years. Absolutely. You know the rule of 72. But that wouldn't be like above the norm. That would be like a below long-term normal rate of return, believe it or not. So all three major averages did close at records. The Dow, that is a record close, but we really just want to see that hit 40,000, just so we could get maybe a new 40,000. I remember the Dow 10,000 hats, but how about a Dow 40,000 hat? That would be cool. But the S&P 500 hit a record for the 23rd time this year, and this is the 18th record high for the Dow and the 8th for the NASDAQ. Now, just so you know, when the market hits new highs, somebody might say something really stupid. Like, oh, the S&P's hit a record 20 times in a row. Typically, when the S&P 500 is rallying, it's going to hit a record a lot of times. And to see it hit a record 50 to 100 times in rally mode, historically would be normal. So it's not out of the norm. All right. Consumer price index rose a little bit less than expected. That was the real charge for the day. Yesterday, producer price index figures came out a little bit higher than expected, but previous months were revised lower. And investors started to get ginned up that the CPI would come a little bit weaker than expected. And the odds of a rate cut are rapidly rising for September. All right, maybe I think the next one after that is November. So we could see 2 rate cuts this year. But just remember, 6 months ago, 4 months ago, we're thinking a couple of rate cuts. Then we started to think no rate cuts. Then we started to think a rate hike. And now we're back to thinking 2 rate cuts. This is a very schizophrenic market. Investors have been schizophrenic. That is one of the reasons why the market's going up. It climbs a wall of worry. So people are so afraid of a down market that there's still cash on the sideline, that fear money, that still could make its way into the market. So we haven't seen that last so-called marginal dollar reach the stock market yet. But the deal is, you saw automobile prices go down. New car prices and used car prices, especially used car prices, are coming down a real lot. Even rents are coming down. Now, real estate is local, so not every part of the world rents are coming down. But overall, on the aggregate, in especially markets that have become overbuilt and saturated, like even Florida, rents and housing prices are going down. In fact, houses on the market, days in the market, have more than doubled, I think, in the last 6 months or so in Florida. So we are starting to see a cooling in the economy. Manufacturing numbers came a little weaker than expected. Retail sales figures came in flat versus estimated to be up, I think, 0.4% year over year. Now, we don't want the economy to slow down. And this is the backward world we live in the stock market, okay, where good news is bad news. So if the economy is strong with good news, good economic stats, that's bad for the market because it means the Fed could keep rates higher for longer, maybe even raise rates more. And higher interest rates makes it harder to value stocks highly. In other words, if interest rates are 5%, that's pretty attractive. If you can get 5%, let's say on a 6-month T-bill or a 6-month CD or a 6 months, or if you get that 5% plus rate in a savings rate, that's pretty good. And maybe you'll want to keep more money in those kinds of investments instead of the stock market. So the stock market has competition. But when rates start to go down and you see the 10-year treasury down to 4.3%, stocks again are starting to look pretty attractive, especially when you take a look at a solid earnings season that we just had, increasing buybacks, dividends. It makes the stock market look like a really good place to be compared to interest rates, which have been moving lower, which is why that's a big reason why you're seeing the stock market go up now. Now, when interest rates go lower, it benefits stocks with high P ratios and high growth rates. That would be technology. It also benefits small cap stocks because if you think about it, large cap stocks aren't really reliant on borrowing. They're more reliant on selling stock in the market. And when they do borrow, they issue bonds in the market. They're not going to commercial banks for loans. Smaller companies, small cap companies, they don't get to issue stock as often. It's still a pretty dead market for stock issuance. So they don't really issue bonds because they're too small. So they are more reliant on getting, things like debentures and, borrowing from banks. So their cost of financing is higher. So when interest rates are perceived to be going lower or could go lower in the near future, it removes a headwind from the smaller cap stocks, and then they could be perceived as more valuable in the future, and they will get marked up to those higher valuations today, which is why you see stocks go up pretty quickly when they react to good news, or at least good news that's perceived as good for the stock market. Let's take a look at a couple of numbers here. All right, pop myself in here. Let's just have the meme stocks up. The meme stocks have caught a lot of attention the last couple of days, but if you look at this is the line at which AMC traded. You see that large gap in that red? It was here a day ago, and it's given it all back down to $5. Okay. And if you look at GameStop, it's backing off a bit, off to almost 20% today. Costs, Clover, still under $1. Wendy's, I think Wendy's is a real company. That's besides the point. Robinhood is just a way to capture on the extra trading volume that the kids are doing. Robinhood is more of a reflection of speculation. So when markets get speculative, I think that's good for Robinhood. It's more trading volume, more payment for order flow. Reddit is, when you have a lot of things going on in the world, it's a good place for more readership, more eyeballs, and they sell more ads. BlackBerry is $3. I don't know anybody that has a BlackBerry. I know they're doing more enterprise software, not really consumer and business, handheld things anymore, but still can't figure out the case to owning. But then again, I really haven't looked that hard. Okay. The U.S. Treasury, the 2-year yield. Look, I've said this many times. When this hits 5%, it becomes too attractive to pass up. It becomes really strong competition for the stock market, and stocks typically go down. When it goes under 5%, stocks rally. That's exactly what happened this time as well. Follow the 2-year yield, and you will have a better handle on market direction, I believe. And let's take a look at all the other things. So the Dow up 350 points, almost 40,000. I mean, less than 100 points away. We could hit that tomorrow. NASDAQ, we were very close about 8 weeks ago, and then everything tanked. And then everything came back. The tank, by the way, from about 8 weeks ago, was roughly a 6% drop in the S&P 500. I just think it was perceived as worse than it really was. Gold hanging in there, just about 2,400. Okay, we went over the S&P already. Oil below 80. That was like 87, 88 at the peak of the bomb rally. The volley between Israel and Iran, and that's basically, oil is still at the top end of its range, but it's definitely way off the extreme top of its range. 10-year, we went over 4.3% change. The VIX is down to the 12s, and that really sums up the day. I want to thank you for watching. If you have any questions about this, ask me in the comments. I will see them, even if you watch this in the replay. So you could watch this in the live stream, but after I'm done, it stays on my timeline, and you could watch it in the replay. So Give it a thumbs up, give it a heart, or whatever reaction is available to you, depending on which social media platform you're watching on. It helps the cause, helps spread the good word with the rest of your contacts. Follow us, Client First Strategy, clientfirststrategy.com for our contact information. And again, ask your questions in the comments. I will see those. I will get back to you. And I want to wish you a very good rest of your day. Thanks.